Ladies and gentlemen, welcome back to the channel. AMC stock is down 1.5% at the time of recording this video. We're going to be going over exactly why that is, what the data is that came out today, as well as a very ominous warning from JP Morgan's longtime CEO, Jamie Dimon. So we have a lot to cover here in this video. Let's go ahead and get started. So first things first, let's cover this ominous warning from Jamie Dimon, because if there's anyone that understands the economy or consumer at a deeper fundamental level than the average person, it's Jamie Dimon. He's been the CEO of JP Morgan since 2005. He's been around in many different crises, managed JP Morgan through the global financial crisis. Obviously, nothing did well at that time, but he's going to have some of the best insight on how people are doing out there, right? And what could affect the economy. He says, quote, warns that all these very powerful forces will impact the U.S. economy in 2024 and 2025. JP Morgan Chase CEO Jamie Dimon said he remains cautious on the U.S. economy over the next 2 years because of a combination of financial and geopolitical risks. Quote, you have all these very powerful forces that are going to be affecting us in 2024 and 2025, Dimon told Andrew Ross Sorkin on Wednesday in a CNBC interview at the World Economic Forum in Davos, Switzerland. Goldman Sachs CEO David Solomon added that he was concerned about soaring U.S. debt levels. He says, Ukraine, the terrorist activity in Israel, and the Red Sea, quantitative tightening, which I still question if we understand exactly how that works, Dimon said. Quantitative tightening refers to moves by the Federal Reserve to reduce its balance sheet and rein in previous efforts, including bond purchasing programs. Dimon has advocated caution over the past few years, despite record profits at JP Morgan, the nation's largest bank, and a U.S. economy that has defied expectations. Despite the corrosive impact of inflation, the American consumer has mostly remained healthy because of good employment levels and pandemic-era savings. In Dimon's interview, the relatively buoyant stock market of recent months has lulled investors on the potential risks ahead. The S&P 500 market index rose 19% in the past year and isn't far from peak levels. Quote, I think it's a mistake to assume that everything's hunky-dory, Dimon said. When stocks are up, it's kind of like this little drug we feel like it's just great. Remember, we've had so much fiscal monetary stimulation, so I'm a little more on the cautious side. I think Dimon, if you've heard anything he spoke recently, he says that there's risk to both sides, that the economy does rapidly slow down, and there's also risks that inflation stays higher for longer. Now, David Solomon said on Wednesday as well that excluding geopolitical issues, it feels better today than a year ago. He was troubled by soaring U.S. debt levels. Quote, I'm very concerned about the growing debt, Solomon said. It's a big risk issue that we're going to have to deal with and reckon with, and it might not happen in the next And it just might not happen in the next 6 months. So basically saying we have longer term problems here. He says, quote, we have to reach the American public, and this is about freedom and democracy for the free world. And that's why the battle is being fought, Dimon said about the Ukraine conflict. Pretty political there. I mean, obviously, come to your own conclusions. Let me know what you think about this information down below in the comment section. It sounds like your biggest banks, though, in the U.S. are not exactly super thrilled with where we are at in this economic cycle. I mean, it's hard to be thrilled, especially, just look at your portfolio. It probably has not done well unless it's in Magnificent Seven names or specific healthcare. So that's not exactly great. Now, what is great is retail sales month over month for the month of December actually came in better than expected at positive 0.6% month over month. Last month, you were up 0.3% month over month, and that was for November. The estimate was 0.4%, so you came in higher than expected. This is good for the economy, and I believe today this was good news, right? Very good news. Retail sales year over year came in at 5.6%. Estimate was 4%. So it's hard to say that these prices are or levels are bad, right? Retail sales up 5.5% year over year. I'm not going to sit here and say that's bad. Export prices year over year and import prices year over year are also coming down quite a bit. negative 3.2% for export prices, negative 1.6% for import prices. That will start to have an effect on GDP as well if that does continue to stay negative. That is to some degree a pull on GDP. Now, it does not look like the Atlanta Fed GDP Now tracker has updated just yet, so we'll have to bring that to you coming in the next video later on in the day today, because this will update based on the information we got today, and that's going to guide a lot of markets' expectations for what's going on with the economy and really what we expect going ahead. Now, big story of the day today, 10-year Treasury yields soaring higher today. Let's see. Well, not as bad now as it was before. Only up about 3.5 basis points. 10-year Treasury now at 4.10%. 2-year Treasury is also up quite a bit. 2-year Treasury up about 12.5 basis points. So you are seeing a yield curve that is steepening a little bit is what it looks like. Yeah, because the 2 years up more than the 10-year. Typically, the 10-year should pay you out more than the 2 years. So you are steepening here on the 10 and the 2 year. So that's actually pretty good news, because when we have uninverted on the 2 and 10 year over the past couple of weeks, it has brought more downside for our markets. And as I can see over here on the monitor, it looks like bonds are definitely taking quite the rally right now. That's why 10-year Treasury yields are falling from the highs that they were at, but we'll see where things hash out by the end of the day today. Now, taking a look at what markets are pricing for Fed policy, you've almost completely priced out a rate cut in March. Still in March, 53.7% chance of a rate cut, so that it's still priced in technically. The odds of a pause at 44.1%, but this is definitely starting to flip-flop, and this is a big driver of some of the downside right now. Markets have been pricing an aggressive Fed policy, and that's just not going to happen according to the data that we're seeing coming out. The markets are now pricing in 1, 2, 3, 4, 5, 6 rate cuts still. Let's go ahead and refresh this, make sure we're looking at the most up-to-date information, and that looks true. 1, 2, 3, 4, 5, 6 rate cuts. It's actually pricing in a greater chance of 6 rate cuts today. Odds of 7 rate cuts are falling, and odds of 5 rate cuts are increasing. So we're still pricing in a lot more than what the Fed has been saying, but you're definitely getting closer to equilibrium with the Fed. If we could price in 5 rate cuts, I think the Fed would be okay with that. 6 rate cuts, probably too much. 7 rate cuts is probably way too much for the Fed's comfort. So that's definitely important to consider throughout all of this. And I think just the simple fact of it is, if we head into Fed Jerome Powell on January 31st and we're still pricing in 6 rate cuts, 7 rate cuts, the markets are not going to like what Powell has to say. When Powell says we're not expecting 6, 7 rate cuts, markets are going to freak out over that. So I think that's a big risk coming on January 31st. That is going to be the next Fed meeting. Now, we do have some earnings coming out this week, specifically an important earnings today in after hours. But that week of January 31st is going to be the big week in which you're going to get your mega cap tech that will be reporting. So that's important. Not this week. Next week, you have Tesla, you have Netflix. The following week after that is when you will get the Fed and all of your big tech earnings: Apple, Google, Amazon, Microsoft, all those other names, Meta as well. So yeah, definitely going to be a volatile period of time over the next couple of weeks. If we take a look at today and after hours, you will have a couple important earnings, specifically Discover. That's going to be your big one. If Discover says something that the markets don't like, if the consumer is, I don't think they're probably slowing down at this point, but if default rates are starting to rise, that's not going to be great. And in my personal opinion, Discover might give us a poor full year outlook. Lower defaults expected, and maybe less spending overall. So we will have to see there, and that's going to be a huge one. if there is anything out of the normal that is said, the markets can react broadly to Discover earnings. And then coming tomorrow morning, you are going to get TSMC as well. And that's obviously important because of semiconductors and chips. Now, let's go ahead and take a look at what's going on here as well. Take a look at the AI Investor Sentiment Survey. We do not have a new one. We should have a new one here pretty soon, either today or tomorrow. So I'll definitely be on the lookout for that one. As far as AMC stock specifically, the stock's down about 1.5%. You hit a new multi-year low here on the day today. You hit a low of $4.06 per share. It's been a rough couple of weeks, couple of months, couple of years for AMC. You did, on a bright side, hit this level at $4.06, and then you bounced pretty dang aggressively, right? From that low, you hit as high as $4.26. That don't sound like a lot, but that's kind of a lot from the lows. If we pull up the 1-minute chart, you can see what I'm saying. You hit that low in the beginning of trading, the first couple of minutes of regular trading, and then you rallied all the way back up to $4.26. That was a big kind of demand point that we hit, that we bounced off of. If you can continue to hold above $4 per share, that might set a shorter term low. Now, whether or not that becomes a longer term low, and AMC maybe never revisits $4 per share or under $4 per share, really comes down to whether or not we get dilution. If we get dilution, say today or tomorrow, AMC stock's going to perform very, very poorly. Okay, that's just the fact of it. You can argue with that if you would like to, but AMC stock will continue to fall on dilution because the dilution that we get from AMC is not enough to offset the dilution itself fundamentally. So what I mean by that is, if we were getting 40 million shares diluted at $4 per share, okay, that's one thing. If we get 40 million shares diluted at $20 per share, that actually could be a bullish thing. That could actually be good for AMC stock. So big difference there. We need to get AMC stock higher before we get dilution. If not, at this point, AMC could pretty soon be a micro stock, right? Could pretty soon be a $2 stock if we were to get dilution again. Dilution's ugly on two sides as well. We've talked about this in other videos, but I want to mention it here as well. Shorts, when they're taking on short positions in AMC, and the stock has seen so much dilution, odds are pretty good that you get more dilution, right? When AMC is able to dilute 30 million shares. I mean, that's not forcing them to cover. That's not encouraging anyone to buy the stock, right? Just knowing that there's a lot of dilution, and there's just any time you could wake up or, midday and find that AMC is diluting shareholders again. It keeps shorts in short positions much the same way as it would keep you in a stock that was doing very well. People don't like to sell a stock that's doing very well, because if it just continues to do well, right? That was like Tesla in 2020, 2021. When Tesla was going through big rallies, nobody wanted to sell. Or GameStop. When GameStop was going through its monstrous rally, that day where it was in the 300s, it was getting halted back and forth, people didn't want to sell, right? Even though there was massive profits, even though maybe they had life-changing amounts of money, they didn't want to sell. Same thing for the shorts that are short. They don't want to cover on their short position. They don't want to buy the stock back if it's just going to get diluted again. So that's a big problem as well. Now, AMC stock is also heavily oversold. This is the most oversold you have ever been. So if there was a time to bounce, it would be right now. The RSI is sitting at 18.24 for AMC, just a reflection of how bad and rough it's been lately. Ever since the last earnings, you've been red way more days than you have been green. And the last dilution, when AMC was $11 per share, crushed the stock. I think Adam Aron learned his lesson that you cannot dilute shareholders again until AMC gets potentially higher than 10, higher than 15, or it's just not doing enough good to offset the dilution, right? Fundamentally speaking, raising capital, maybe even at $11 is futile. Maybe it's not enough for AMC stock. So I do expect good news any day now. We'll see. I never put anything past Adam Aaron. He always amazes to surprise me with some of the crap that he pulls, but we'll obviously see. The stock is definitely ripe for a bounce here. But it's obviously not guaranteed because we just don't know what's going to happen. But I will tell you, risk to reward looks pretty attractive right now, especially for some longer term options. If we do get that commitment that Adam Aaron will not be diluting shareholders for a period of time, I would expect those to do very, very well. So you guys have a great rest of your day. That's going to do it. Hit the like button as well as subscribe to the channel. Thank you for watching, and I will see you in the next one.